Hello. In our last segment, we covered what the Freedom Creation Account, how the put and take account was for liabilities, and how the Freedom Creation Account moved money to a account, the perfect account called the Freedom Reserve Bank. So what we're going to talk about today is what that properly structured permanent life insurance contract is. Now, to understand this, properly structured permanent life insurance is not something that just rolls off the tongue of most people. Most people don't even understand the different types of insurance that is out there. So I want to give you, as brief as I can, an education that you can look back at and say, I get it. Now I'm going to talk specifically about a 35-year-old person, but I'm telling you that it works whether you're 35, 25, or 70. What I'm going to show you can work at any age. It just works wonderful if you learn these concepts. So let's talk about the three types. The first type is term insurance. Most people know that term insurance, if they buy it between ages 35 and 100, that it's a contract that protects them. If they die, it protects their income. It replaces their income to their family. And by the way, I believe everybody should own a bunch. I think people should own a bunch of life insurance, because if you die, your economic engine is done and your family is left behind. So I'm a real believer in getting the right amount of life insurance. But that's the first type. The second type of life insurance, do you know what it is? If you've guessed permanent insurance, you're right. Permanent insurance has another term that most people have heard: whole life. Whole life insurance is the other type. Now guys, I'm telling you this because there's 2,700 life insurance companies in the United States. They have 10 to 20 different products each. So when we're talking about 30 to 50,000 different product names, do you think there's a little confusion in the world? So the three types: term insurance is one, permanent insurance is number two, also known as whole life, and the third type is adjustable insurance. These three types I'm going to break down so that you can understand each one of them on how they work. We're going to start with term insurance. Term insurance, if you're a 35-year-old and you wanted to buy $1 million of death benefit, it would cost you about $1,000. Pretty cheap. $1 million. Why is it so cheap? Yeah, it's because you're not going to die. Yay! Right? So it's cheap. $1,000 gives you $1 million of protection if you did make the mistake and die. That $1 million would be paid to your beneficiaries tax-free. They don't make money when you're dead. See, it just replaced your economic engine. And I think earlier in a segment, I showed some of you that you could be worth several $1 million economically. All right? But how this works is this. The cost goes up as you age. So every year you get older, you get closer to what? Yeah, dying. And the closer you get to dying, guess what the insurance company wants to charge you? More, right? So most people buy this for a term, and they plan to get out of it. See, they know that they need insurance when they're young, but they feel like when they're old, when it gets expensive, they want to get out of it because they need cash, right? That's actually called the theory of decreasing responsibility. It's a great theory, but the reality is that people need to rely on their money only if they plan to use term insurance. So term insurance is a great vehicle to protect your family. You can buy it in tranches of time. You can buy it in 10-year terms or 20-year terms. And what happens when it gets to the end of a level period, the premium goes up in a jump. Makes sense, right? Because you're older. If you buy it for 20-year blocks of time, it just goes longer and makes a higher jump. So everybody that's listening to this, I believe this is the easiest thing to understand. You got this, right? Okay. That's how term insurance works. It just gets more expensive. And by the way, I've never met an agent, ever, an insurance agent that said you could keep term long term. They all know that you don't. By the way, 98% of all term contracts purchased are canceled without making a payment. So the insurance companies, how would you like to have a product that you actually sold millions and millions and billions of dollars of, and you only had to pay out 2% of the time? Do you think this is kind of a little profitable deal? It's great for them, right? It's also good for you, so don't worry. The second type of insurance is permanent life insurance. Now, this works completely different than what I just showed you. The term insurance is easy. You die, they pay. Okay? It's cheap. Permanent life insurance has a lot higher premium. It's a $10,000 premium for the same amount of death benefit. So if you're paying for $1 million and you wanted permanent life insurance at age 35, you're going to have to cough up $10,000. By the way, does this make sense? Why about 95% of everybody you know buys term insurance rather than permanent? Yeah, it does. But this is how it works. I'm not telling you should do this. I'm just wanting to show you this is how the program works. You put a $10,000 premium every year. You notice the premium never goes up. It stays the same from age 35 out to 100. So the premium is level. What happens in the early days of a permanent contract, a whole life contract, is most of the premiums that you put in are used by the insurance companies. See, the insurance companies know that they have to have the promise fulfilled that if you die, no matter where you die, they got to come up with $1 million. So they front load all of the costs of this product. They also pay their agents buku bucks to sell this type of insurance because it's a lot of premium dollars. They pay their marketing, they pay their employees, they build their monstrosities of assets, all on the backs of these insurance products. But this is how it works. $10,000 goes in, it's front loaded in cost. The first 7 or 8 years, the costs actually are reduced in this program. So what happens is when you get down the road 3-4 years, a cash value starts to grow inside this contract. That cash value grows with all of the tax advantages that I talked about earlier and all of the access that I talked about as the benefits of a program. The problem is that it's a pretty poor investment. All right? So when you understand how the pundits talk negatively about permanent life insurance, it's because it does not pay real well. In fact, it's a low to mediocre investment at best. All right? But that's how it works, guys. Long run, it does work out. Long run. All right? There's a third type of insurance that I want to have you see. The third type is called adjustable insurance. Now, adjustable insurance has a lot of different names. It could be universal life, flexible pay life. It could be adjustable life. It could be presidential, adjustable, flexible, whatever. I mean, the industry has come up with more names to confuse people. This product, I'm telling you, it is one of the most irritating products that I have learned in my past and in my present. I cannot believe all the bells and whistles, fees and charges, and things that are added into this that clients have no idea what they're buying. But they heard it's permanent. I'm telling you straight up. By the way, if there's an agent listening to this right now, I'm just smiling with you because I don't like this product. I think you might catch that, all right? But this product works like this. You put in less premium. You don't put in the $1,000 that the term insurance cost, and you don't put in the $10,000 that the whole life program costs. You put in somewhere in between. They call it the target premium, $4,000. So if you put in $4,000 inside of a contract and it has a cost engine the same as term insurance, now I gotta go back and have you think a little bit. What did term insurance cost? What did term insurance cost? It cost $1,000, right, when you were young? Well, if you're putting in $4,000 of premium and the cost is $1,000, do you see where you might get a cash value growing inside of a contract like this? Yeah, that's where the $3,000 comes from, right? So this is how it works. In the early days, this contract grows its cash value very aggressively. And they show you an account that shows, man, look at that money grow. But they also have this thing called a surrender charge in there. So all the money that's growing in there is reduced by the surrender penalties in this contract. All right? How this works is simple. Once the line of cost crosses over the amount of premium you're paying, something begins happening to the cash values. See, if you're only paying $4,000 and the cost of insurance was $5,000, where do you think the extra $1,000 comes from? Yeah, that's right. It comes from your cash values. Did you read it? Nobody does. All right? But if you did, you'd find out that's how it worked. And what happens is as you age and as that cost line continues to grow, your cash values will have more and more and more pressure unless you increase your premium. So if you keep your premium the same, every contract that I have seen, I'm telling you, every contract that I have seen says somewhere around the mid-70s that if this policy will terminate, if premiums paid and interest credited are no longer sufficient to maintain coverage. Now, how would you like to buy a plan when you were in your 30s and find out at age 70 that the premiums that you thought were the cost turned out not to be? What if what you thought to be true turned out not to be true? When would you want to learn it? All right? So when we're talking about these three types of insurance, I hope that has given you a concept of how an industry has grown millions and billions and trillions of dollars of assets by products that are very, very needed, very useful, very good for them, and good for some people that collect. We need to learn a different way of structuring this product because it has awesome benefits. I'm going to get to that in the next segment.